Chapter 4, The Innovator's Dilemma by Clayton Christians, and we're finishing our discussion of Chapter 4 and focus on the last piece of the chapter, which talks about the steel industry. We're relating that to Tesla and other technologies, in particular CRISPR, which is another big part of our portfolio. This is the Not Even Wrong podcast. It's November 15, 2020. This is Krim Delco. Today's a Sunday. There's no update. We are talking about the Innovator's Dilemma, Clayton Christensen's book, which is part of our principle stack, the 4 books, 0 to 1, the innovation stack, the Innovator's Dilemma, and the beginning of infinity. So we are discussing the Innovator's Dilemma. We're in chapter 4, and we've already had a few episodes about chapter 4. Today we're finishing chapter 4, and the main topic of chapter 4 is that managers in incumbent companies, through rational decisions, good managers, good people with good intentions, are making the company miss on disruptive innovation, and therefore they open a vacuum for new entrants. And sometimes this can actually become a demise for the incumbent, or sometimes it just means they lose a lot of market share. The managers do that by following the customers. They follow profitability, high margins, high ROICs. So they do pretty much everything that is taught in business school, everything that even common sense entrepreneurs would think is the right thing to do, and still they fail. This is the main topic of chapter 4. Christensen uses the disk drive industry and then also the steel industry. And I think the steel industry is actually a beautiful example. It's kind of much more intuitive than disk drive, because I feel like with disk drive, it's always because it's so small and tiny and so high tech, it's very difficult for us to imagine. The steel industry is a little bit easier. So you have integrated steel companies. Those are companies that do everything from pretty much burning the iron all the way to making the big slabs and the sheets for cars and cans for Coke and steel rebar also for construction. So pretty much the whole thing, integrated steel companies. This is how it was 100 years ago. Bethlehem Steel, US Steel, all these large companies. Every industrialized country had their big integrated steel industry. And then we have this innovation called mini mill, which is you take scrap metal, you squeeze it back into a smaller sized furnace, and you produce steel out of that. Let's not go into the details, but think about you first of all, you can recycle steel, you can melt it and produce it with much less capital investment, much less size, furnace, less labor, all that stuff. The problem in the beginning is it's very low quality steel. So what happens is the incumbents, they don't care about this because they are going after the high margin, let's say luxury cars, things like that. The first application that the mini mills can do is what's called rebar, reinforcement steel bars. Those are those things that you see when a building is being built, and it kind of looks like a skeleton of a building with these rebars. I mean, those kind of pipe types, thin pipe type steel pipes that are there to reinforce the concrete when a building is built. Those are not very high quality type steel. This is not high quality type steel. You don't see it, you don't touch it, it's not exposed to the elements because it's inside of the concrete once the building is done. So the mini mills start doing that, and the incumbents, they figure, look, we don't care. This is a commoditized market, a typical situation where you have a price taker, price decisive market. There's really pretty much no quality. And I can attest to that. We at Orange Capital Partners years ago have been looking at the Chinese steel industry, and we visited some steel companies, and they were exactly in that business. So the low-end Chinese steel makers, they also are in that business. So it's anyway, long story short, it's a very commoditized market. It's all about price. It's all about gross margin. How much do you pay for the how much do you pay for the iron? How much is the cost, the variable cost, and what can you get? There's no differentiation whatsoever. So the mini mills enter the market because they have a lower cost structure, they immediately take over the market, and the incumbents don't really fight because it's a low margin business anyway. They go into higher margin products, again, things like luxury cars, fancy buildings. I don't know, wherever you need high quality steel, wherever steel has to be exposed to the elements, it should not erode, it should not crack, all that stuff. It should look nice. So they keep going into higher margin and higher margin businesses and leave the lower end, the rebar, to the mini mills. The mini mills over time start making better and better steel. So then there are some other innovations that help, let's say, roll steel much, much more efficiently. Again, something in the beginning, it's not exactly the kind of rolling that the integrated mills do, which is very high quality precision. Like if you, let's say you roll this super hot steel to the point where it has to be equal size, equal width, and all that. So it's probably very difficult to do in the beginning with the lower cost, lower capital intensive technology, but over time they keep catching up. So what happens with the steel industry is that over time, the mini mills have taken over the market. They actually have pushed out the incumbents, and today, I would say the only surviving companies in the United States, the real American steel companies, are mini mills. There are no others. I think US Steel and these types of companies, they're kind of virtually bankrupt. And I mean, Donald Trump made a big splash out of saving them. To some extent, they're also being exposed to Chinese competition, and there's a lot of dumping and things like that. So I don't want to go into details there. But my point here is that you have a very simple market where disruptive innovation can be shown how it's leading towards new entrants taking over the whole market, and the incumbents not able to respond, and not responding because they're doing the right thing. So this is, in a nutshell, what chapter 4 is trying to make a full point about. We have applied this concept to Tesla. We've discussed, is this a risk for Tesla? Are the new Chinese entrants in the electric car market a risk to Tesla, in particular companies like NIO, Li, and XPeng, and BYD, and so on and so forth? The Chinese have already the largest volume in electric cars. However, most of the electric cars that the Chinese are making are very, very low-end cars. In fact, sometimes they're just skateboards with some technology attached. So our first reaction would be, well, Tesla is in the luxury electric smart vehicle market. Tesla is in the decarbonizing energy market. So they are not competing with low-end Chinese cars. That would be our first reaction. And I think right now, today, this is probably how you could characterize the market in China. I'm not even talking about international markets yet. So in China, you have a certain upper middle class and rich people. They buy luxury cars, and Tesla competes with BMW, Audi, and those types of cars. They're not competing with BYD or NIO or XPeng or any of that. NIO is claiming to compete with Tesla, and it's possible that there are some overlaps there, but we would think that the quality and the network and the UI and the software parts of Tesla are good enough still. So people who want that kind of experience, the kind of experience that we have here in California when we buy a Tesla, there's a rising class of Chinese, wealthy people, professionals, technology enthusiasts who want that same experience, and Tesla is catering to that market. The question, of course, is, can Tesla be disrupted by those incumbents, NIO and down? When I say NIO and down, I mean NIO is sort of the highest end Chinese manufacturer, and then it goes all the way down to the skateboard with technology attached to things like candy and whatnot. Is this a risk? And we've answered that question by saying that, first of all, Tesla has announced a $25,000 car, fully equipped with autopilot hardware. Probably it will cost a bit more to have the autopilot, but the point is, you have a high-tech, super fancy, interesting car, let's call it sexy car, I don't know, whatever word you want to use, and it's $25,000. So it has the Tesla brand on it, so it has the quality and the performance and the network and the service and the software updates and the connection with the photovoltaic industry that Tesla offers, either verbally or in some cases really physically, where you can actually download photons through the Tesla system, battery, power pack, etc., all the way into your car and drive pretty much with photons. So all that experience is Tesla has that in China, and can that now be disrupted by the Chinese? Is this possible? And we've said no because of the $25,000 car and the cost structure. This is the key. Tesla is working towards a cost structure to enable that. This is what gives us the confidence that Tesla will be fine, because the cost structure of Tesla is such today that they can make money with an ASP of something in the high 40s, low 50s. They will have to make money in the high 30s, low 40s. Once they're at that point, we believe they can have a 30 or 40% global market share of the whole electric car market, and assuming that in 10, 20 years, every car will be electric, they could have 20, 30%, 40% market share of the global car market with that offering, the same way Apple has a very high market share in smartphones, or Amazon has a very high market share in cloud computing and online retail, the two big markets that they're playing. So we think that Tesla is prepared for that risk. They're not ignoring it, and they are not, how should I say, they're not falling into the trap of the innovator's dilemma. This is the key. And I want to finish the discussion of chapter 4 and also make another case for why this podcast is so specific about the principle stack that we have in our Orange Capital Partners. And it comes back to the point that we need good theories to make money. Good theories are fundamentally necessary for wealth creation, because good theories, or to use David Deutsch's words, good explanations of natural events or of things that we're observing, of things that we're exposed to, either physical things or even abstract things, it doesn't matter. But we need good explanations, and hence also the name, Not Even Wrong. If you don't have a good explanation for something, you're not even wrong. In order to earn the right to be wrong, you have to have a good explanation, and a good explanation for processes in the real world is always one where the things that you're explaining have some direct relationship with the actual thing you're observing, and you're also not using tautologies, and you're most importantly, you're not using things like, well, it's so difficult that it's impossible, and therefore it's impossible, or something like that. Like, you're not using these circular references which say nothing. So a good theory is fundamental in wealth generation. We at Orange Capital Partners strongly believe in that. So we consider ourselves lucky that we've discovered that through reading all these books, and particularly the 4 books that we're mentioning. There's many other books, of course, that we're reading. We're constantly reading and trying to understand in what's going on in the science community. We believe there's a very strong relationship between the evolution of science, the evolution of business, the evolution of natural evolution. The arguments in science are very similar to the arguments in the investment world. There is always emotionality. There's always this tendency of people towards being against new ideas and trying to preserve the old. And then the new ideas, to use Thomas Kuhn's, to paraphrase him, then the paradigm shift comes along and changes everything. Schopenhauer said, in the beginning you're ridiculed, then tolerated, and then you become mainstream. It's just another way to explain the same process that disruption is going through, which is in the beginning you're ridiculed, you're low end, nobody wants to deal with you. Then you're tolerated once you start creeping up in the market, and then you end up being the market because you push out all the incumbents. You become the standard. So there's been a lot of other books, philosophy, technology, the popular technology, even non-popular science. So when it becomes very technical, if you really go through the nitty-gritty details of how that works, it's very similar to what we're exposed to as investors. So I want to, just to summarize and end this episode, the point, I cannot emphasize enough how important good theories are. We believe that the beginning of infinity is the foundation of the way we think about creating theory. So it's an epistemological book. It's a book about how knowledge is created. It explains unbelievably difficult concepts such as the multiverse, for example, and I think it explains it in a way. I'm not going to claim that I can imagine what the multiverse is, but David Deutsch explains it in a consistent way, so I can follow his argument and I can attempt to understand his explanation. Brett Hall, in his podcast Toughcast, talks about certain conversations with certain intellectuals, and they say things like, I don't believe in the multiverse theory, it is stupid. They're using words like that, and this it reminds me very much of the process on Wall Street, where you hear such things like, this company is stupid, or their approach is, I don't believe in their approach. We're not in the business of believing. We're certainly not in the business of deciding what is stupid and not stupid. We're in the business of trying to be as objective as we can to find the best possible processes, ideas, entrepreneurs, collection of ideas, collection of people, the best possible combination of all these possible vectors so we can generate wealth. And wealth generation is nothing but the measure of freedom. So we have a fundamental, it's our fundamental task. It is what we're trying to achieve here, is to get as much freedom as we can for us and our investors, so we can then proliferate that freedom to other people, and if you want, for the rest of the world. This is the fundamental purpose of Orange Capital Partners, and the beginning of Infinity is a beautiful foundational intellectual work that helps us get there. 0 to 1 is a little bit more specific about what exactly is necessary in terms of more abstract thinking. Who is capable of creating wealth? The entrepreneur, the monopolist, the person that is unique, that has the ability to see things differently, to understand something that everybody else either disagrees or doesn't even understand, things like that. The innovation stack is even more practical. It comes down to the fundamental idea of, okay, once you start building, how do you actually build? You start by solving problems, creating new problems, solving problems. I want to inject here David Deutsch's definition. A problem can only be solved if the solution creates less problems or new, more interesting problems. You cannot solve a problem by creating even more problems, and not by which are worse than the problem that you're solving. Good example is COVID-19. By doing lockdowns and killing our economy, we're solving the COVID-19 problem by creating even more problems. That's not what the innovation stack is talking about. That's not what Jim McKelvey is talking about in his book. He's talking about the David Deutsch type solution of problems, where you create problems, solve them, and solve them in a way that the new problems you're creating are better problems, even more worth solving. And then the compound of these solutions, or if you want, the compound of knowledge, creates wealth. And finally, the Innovator's Dilemma, which is the book we're discussing currently, is a book where, first of all, it's I would say, the spiritual base of Silicon Valley. So it's important because people believe in it. I think it's incredibly misunderstood across Silicon Valley in particular, and even much worse in the rest of the business world. So people talk about disruption in many different, even Peter Thiel, I think, hasn't understood the book properly. He says, for example, don't disrupt. So he's using disruption in a Silicon Valley style way, which is, in that sense, is correct. You don't want to be a disruptor. A disruptor in the Silicon Valley sense is somebody who just goes, kills all the porcelain in the store, or like it creates a revolution, changes things, pisses people off, that kind of thing. That's not what Clayton Christensen talks about. Clayton Christensen talks about disruption as this new idea, new technology, new explanation, new instantiation of theories and ideas into a technology which fundamentally is different, changes the cost structure of a certain process, of a certain company, and enables new markets. That's what disruption is. And in that sense, everybody wants to be a disruptor if you look at it that way. I'm sure Peter Thiel would agree with me. Thank you.